Hello everyone and welcome back to another video. So I've been getting asked for my thoughts on Amazon stock because it has been underperforming the S&P 500 so far this year and over the past 5 years as well. It really seems like the sentiment towards Amazon stock is getting more and more negative, especially as it continues to underperform. So I want to update you with my thoughts on Amazon, what I think about it now, and also share a lot of recent news that has been coming out with this business. Then I want to play you a new Bruce Flatt interview where he talks about how Brookfield is investing in the artificial intelligence space and what he says I think applies to AI as a whole. So with that being said, let's hop right into the video and start off by discussing Amazon stock today. So let's start off by taking a quick look at Amazon's performance. And here we can see that the stock is up 2.8% year to date versus the S&P 500's 15.8%. So it is underperforming by roughly 13% so far this year. If we take a look at the past 5 years, we can see that Amazon is up 41.2% versus the S&P's 84%. So over the past 5 years, it is underperforming by 43%, which is not ideal to see, and you can see why the sentiment towards the stock is getting quite poor. However, I don't think that people should be looking at a stock's historical performance as an indicator to what it will produce going forward, because in my opinion, Amazon was actually quite overvalued in 2020 and in 2021, especially during the COVID era. So I do not think that taking a look at Amazon's share price performance relative to when it was extremely expensive is necessarily wise. And again, I don't think it tells you how the stock is going to perform going forward from here. So let's now take a look at some of the recent news that has been coming out with Amazon that I think is actually quite bullish. Amazon recently held its AWS reInvent presentation, and it announced a ton of new product updates. The first one is that Amazon introduced Graviton 5, which is said to be the company's most powerful and efficient CPU. This CPU is also said to provide the best price performance within Amazon's own data centers. Amazon then said that over half of new CPU capacity for AWS is powered by its own Graviton chip. 98% of its top 1,000 customers are also using Graviton and sharing that it is providing great results. For example, Adobe is reportedly using Graviton for broadcasting and viewing experiences. Epic Games is using it for gaming experiences, and Formula One is using Graviton chips to help fans keep up with the drivers. And by the way, my wife and I recently started watching Drive to Survive on Netflix, and it is absolutely fantastic. We have never been interested in Formula One, but now we're talking about when we're going to go to our first race. So if you have not watched that series, I would definitely recommend it, and Formula One is freaking awesome. But getting back to the video, Airbnb said it is seeing improvements of up to 25% over other systems by using Amazon's CPUs. So it seems like Amazon has built a great CPU, and customers are directly benefiting from it and reporting that they're seeing great performance. Additionally, Amazon using its own CPUs within AWS increases the cost competitiveness of AWS as a whole, which ultimately increases the moat of this business. Moving on, Amazon also announced new Nova models, which will allow businesses to build their own models and agents. They then showed how Nova compares with multiple different models, including the new Gemini 3.0, which created a ton of hype online. And here we can see that Nova is competitive with Gemini 3.0 and actually beats it in long context coding, instruction following, query-based video highlights, accuracy, and agentic workflows and coding. Gemini still wins in a lot of areas, but Amazon's Nova seems to be great for businesses with the better coding and agentic workflows. Amazon then announced that its Trainium 3 Ultra servers are now available, which allow customers to train and deploy AI models faster and at lower costs. Trainium is Amazon's in-house chips, which are specifically designed for AWS workloads, and they're a lot like Google's TPUs. Customers like Anthropic are reporting 50% reduced inference costs and up to 4 times faster inference for real-time generative video, at half the cost of GPUs. This means customers are getting a huge speed boost and at huge savings by using Amazon's Trainium chips. This reduces Amazon's reliance on NVIDIA and once again increases the competitiveness and expands the moat of AWS. Recently, Andy Jassy, who is the CEO of Amazon, also said that Trainium is a multi-billion-dollar business that grew 150% quarter over quarter. Again, this is quarter over quarter. This is not year over year. This was also in regards to Trainium 2, which is what Anthropic is currently using to train its Claude model. Additionally, Anthropic is running Claude on roughly 500,000 Trainium 2 chips, and that is expected to double by the end of the year. However, Amazon is already working on Trainium 4, which is showing 6x the processing performance, 3x the FP8 performance, which means that you can train models at least 3 times as quickly or run 3 times more requests. This is on top of their already incredible existing Trainium chips. So if the Trainium 2 chips are already fully subscribed and completely sold out, then I imagine that there will be tremendous demand for Trainium 3 and Trainium 4 chips. Having these chips should attract more customers to AWS and result in increased market share. Now, some additional recent news that came out is that Amazon is in talks to invest up to $10 billion in OpenAI. Further down in this article, it also says that OpenAI is planning on using Amazon's Trainium chips, which would directly compete with Google's TPUs and NVIDIA's GPUs. Now, as I have been saying on my channel, I don't love OpenAI because the business is burning tens of billions of dollars, and it doesn't seem like they have any clear path to becoming profitable anytime soon. But at least for Amazon shareholders in the meantime, it could be good if OpenAI wants to burn some of their cash on paying for Trainium chips. Again, I do not necessarily love this, but it could cause Amazon to see a short-term boost to revenue over the coming years. All of these recent developments are helping Amazon see a re-acceleration to its AWS revenue growth. In fact, last quarter, AWS added $2.1 billion in revenue in the one quarter alone, which was the highest amount of net sequential revenue growth for AWS over the past 5 years. But now let's switch gears a little bit, where Amazon recently announced that it wants to invest $35 billion into India's economy by 2030. The goal of this investment is to accelerate India's digital transformation, strengthen its infrastructure, and support innovation throughout the country. Now, the reason that I like this is because India's GDP is expected to grow by roughly 60% from 2025 to 2029 in terms of US dollars. The country is seeing rapid growth, and Amazon is trying to capture some of this growth by continuing to invest in the digital transformation of the country. But now let's talk about Amazon Leo, which used to be Project Kuiper and directly competes with Starlink. And here this article says, Amazon Leo, which used to be known as Project Kuiper, recently debuted its new gigabit speed antenna. Further down in this article, it also says, Amazon Leo has already signed agreements with companies like JetBlue and Hunt Energy. Hunt Energy CEO then said, the combination of Amazon Leo's bandwidth capabilities and secure private link is exactly what the company needs. And personally, I think Amazon Leo will be a massive business one day, far into the future, but right now it is a total cash burn on the business and it is lowering Amazon's overall profitability. But as an Amazon shareholder, I also understand that this is just the nature of its business. Amazon likes to take all of its operating profits and reinvest it into growing the business, whether that be into AWS expanding data centers and expanding on things that are already working, or investing into moonshots like Amazon Leo. And I do like that Amazon does this because at one point, AWS was also viewed as a moonshot. And just look at how that has worked out for the business. So by Amazon continuing to invest its profits into new innovative ideas like Amazon Leo, it could be actually creating the next AWS. We just don't know it yet. But overall, I think that there are a lot of positive developments happening within Amazon's business, especially in regards to AWS. Andy Jassy has also said that AWS is projected to double its data center capacity by the end of 2027, which I think is very bullish for the overall business. Amazon has also said that all of the new capacity they're bringing on is being monetized immediately. So they're seeing immediate returns on investments as soon as they stand up a new data center. So I think them doubling their data center capacity over the next few years is just mind-blowing, and we're going to have to see how this all plays out. And due to all of this recent news and all of the developments that we have discussed, analysts are now saying that AWS revenue could accelerate to 25% in 2026, with some saying it could be as high as 36% by the end of the year. Now, I don't know about 36% growth, but I do think that the reacceleration will continue as so much new capacity comes online and their product sales continue to grow. So let's head over to Stock Unlock now and take a look at Amazon's advertising revenue, because I noticed something that is kind of interesting. In the third quarter of 2025, Amazon produced $17.7 billion in advertising revenue. Now, if we take a look at the fourth quarter of 2024, and Q4 has historically been the company's most strong advertising revenue quarter, we can see that Amazon had $17.3 billion in advertising revenue. Now, what this means is that in the third quarter of 2025, Amazon produced more advertising revenue than in the fourth quarter of the previous year. And this is the first time that this has happened, which ultimately means that Amazon's advertising revenue is accelerating at scale. And I think it also suggests that Amazon is going to have a monster fourth quarter for advertising revenue. I also found the screenshot on X, which shows that Amazon's advertising revenue accelerated to 24% last quarter. Meta did grow the fastest at 26% though, but Amazon is still seeing strong growth and is continuing to take market share. This is a highly profitable business for Amazon, and again, I think that it is going to report a monster fourth quarter. It's estimated that the Amazon ads business has 50 to 60% operating margins, which is even more profitable than AWS. This is mainly because Amazon's ads run on servers, websites, and apps that are already built, paid for, and maintained by the retail and AWS business segments. Additionally, Amazon can charge a higher CPM due to the high intent of buyers on their website. In other words, Amazon's ads are extremely valuable to advertisers, which leads to this being a very profitable business for Amazon as a whole. So now let's go and take a look at how Amazon is being valued today. And personally, I like to use the price to operating cash flow ratio to value this business because it has been the most consistent and accurate one historically. And here we can see that Amazon is currently trading for 18.5 times operating cash flows, and its long-term average all the way back to 2008 has been roughly 26. So Amazon is trading well below its historical average price to operating cash flow multiples. And what's also interesting is from roughly 2010 to all the way in 2023, Amazon's price to operating cash flow bottomed right at 20. That is the cheapest the market used to allow Amazon stock to get. But after 2023, the price multiple has been compressing, and it seems like it's actually been topping out around 20 to roughly 21. So post 2023, it seems like the market has been valuing Amazon's stock lower on a price to operating cash flow basis. Now, this could be due to the company seeing lower top line revenue growth and therefore the market wanting a cheaper multiple for the slower growth rates, or it could be due to the negative sentiment that Amazon stock has been seeing, with it underperforming the S&P 500 pretty consistently over the past 5 years. So I don't know if investors are just fed up with Amazon stock right now, or they do want to discount relative to how they have valued it historically, or maybe a mixture of both. But overall, I personally think that Amazon stock is looking pretty attractive right here, and an 18.5 price to operating cash flow for this business, I think, again, is quite fair. Now, I'm also working on a new tool over at Stock Unlock to help better identify when a stock is overvalued, fair value, and undervalued. This feature is not yet released across the platform. It is still in beta and I am testing it, but I think that it is working pretty well on Amazon. And how this chart works is when the share price is orange or red, it means that the stock is expensive or very expensive. When it is yellow, it means that it is selling for roughly fair value. And when it is green or dark green, it means that its valuation is low or very low. And what we can see on this chart here is that back in 2020, Amazon stock was quite overvalued. Then we got that correction at the end of 2022, which led to Amazon being extremely cheap in my opinion. And this is where I was buying a lot of Amazon shares. And since that correction at the end of 2022, when the valuation essentially reset itself, Amazon stock has actually been looking a lot more attractive from a valuation basis. And today, I do still think that the stock is looking undervalued, but it is getting close to fair value, at least in my opinion, and I don't think that it is extremely undervalued today. I also ran a quick discounted cash flow calculation on Amazon using its operating cash flows and projecting them out over the next 5 years. And in this DCF, I'm saying that Amazon will continue to grow its operating cash flows by roughly 15% annually going forward and trade for a 20 price to operating cash flow, which I think is fair for the business and does factor in a slight multiple expansion from today's price. And if Amazon can achieve these metrics, then the compounded annual growth rate to the share price could be roughly 15%, and its fair value would be $284 per share, which is roughly 25% above where the stock is currently trading. So again, I do think that Amazon stock is offering value today, but I don't think that it is at like drop dead prices or I need to go and buy a crap ton of Amazon stock right now. I think that if the business can continue to grow decently over the next 5 years, then the share price can outperform the S&P 500 and produce those 15% annual gains, but it's not like a 20 to 30% compounded annual growth rate from here. And that's why I think that the stock is looking attractive, but I don't think that it is like a severely undervalued business or a must buy today. at least in my own opinion. But overall, Amazon's fundamentals seem like they are continuing to grow. They're having successful product launches. AWS seems like it's reaccelerating and will continue to reaccelerate. Amazon Ads is absolutely killing it, and the business has multiple flywheels that are continuing to fire. So I think that people just need to maybe stop getting so distracted by what the share price has done over the past year or the past 5 years, and really try to focus on the underlying fundamentals of the business and the value of the business today relative to those fundamentals. Because the reality is that Amazon's fundamentals have grown significantly over the past 5 years, while the share price has not grown at the same rate. And over the long term, eventually the business and the share price will more accurately converge and reflect each other. But it could take some more time for this to happen, and that is why patience is important as an investor. And in fact, the longer that Amazon's share price underperforms while its fundamentals continue to grow, the better that will actually be for long-term investors who are net buyers of Amazon's stock. And that's how I like to think about investing as a whole. But with that being said, those are my thoughts on Amazon, and those are some recent updates with the business. So now let's get into the Bruce Flatt interview that I think applies to all artificial intelligence stocks. All right, so let's play the highlights from this interview, and I will be pausing throughout to add some additional context. So let's get right into it.
So the new partnership that Sarah just outlined, that's part of a new strategy aimed at investing in infrastructure broadly, tied to AI. You have $10 billion in equity through your own balance sheet and third-party investors, including NVIDIA, and along with co-investments in debt. You plan to build and acquire as much as $100 billion worth of AI infrastructure. This, of course, is against this backdrop of concerns about where we're at in the cycle. Are there still places to deploy that you feel like aren't frothy at this point in time?
So maybe the most important thing is that what we do is lay the backbone infrastructure around the world in different sectors for centuries. So we've been doing it in real estate, we've been doing it in pipelines, we've been doing it in roads, we've been doing it in rail for many, many decades. And now all we're doing is partnering with companies and countries to lay the next backbone of global infrastructure in their country. And in Qatar, we've announced this project where we will lay artificial intelligence infrastructure in the country. And why it's important is that each country needs to have artificial intelligence backbone to drive their economy in the future. And if you don't have it, businesses will leave. And that's really important. And this is a 20-year runway. So you can pick and choose in the stock markets. That's not our business. Our business is just about laying infrastructure down. And what's important to us is finding power, building data centers, building compute capacity, and finding counterparties that have good credit quality on the other side. And if you do those three things, you will have very intelligent investments that earn good returns for very long periods of time, and that's what our business is about.
Infrastructure.
So I thought that was beautifully said from Bruce Flatt, who, by the way, is the CEO of Brookfield Corporation, which is the largest position in my portfolio. So what Bruce is saying here is Brookfield has been investing in infrastructure for over 100 years now. This is what they specialize in, and it quite literally is what the business does. And Bruce Flatt views this artificial intelligence build-out as just another pillar of the global infrastructure. It's a brand new pillar. That's kind of why it's making a lot of people nervous, but that's how Brookfield views it. That's the lens that they're viewing this investment through, which is no different than what they have been doing for decades, building out the railway infrastructure, building out renewable power, building out power as a whole, building out real estate infrastructure. Artificial intelligence infrastructure, to them, again, is just another pillar of their business and the global backbone of the economy. And this is partly why Brookfield has been my investment choice to get exposure to the build out of artificial intelligence, is because they have that long track record. They have the experience of doing this stuff. They financed it before. And also because I think infrastructure is guaranteed to need to be built. There's going to be a massive demand for infrastructure over the coming decades as artificial intelligence continues advancing, and we need more electricity and data centers and real estate to actually power artificial intelligence. So this is the way that I have chosen to play artificial intelligence. And that's because I'm not smart enough to know which LLMs are going to succeed or which chip provider is going to win over the next 5 years when it seems like every company is coming out with their own chip now. And that makes me a little bit concerned over the margin potential of a business like NVIDIA or AMD when their own customers are trying to build their chips. And it seems like their chips are being successful. I'm talking about Google's TPUs and Amazon's Trainium chips. And then also LLMs, I've been saying on my channel for quite some time, I think it's a commodity. And as a consumer, I've actually never paid for an LLM yet, and I've been getting by just fine. And I think the average consumer is going to have a tough time wanting to pay $20 for Gemini or ChatGPT. I think that these are going to be more so business to business products, B2B products. But your average consumer, such as myself, I don't care to pay for any LLM because I can access Claude or Grok or Gemini for completely free. And it's been working just fine for me. So I've been struggling to see how LLMs are going to be a profit generator for any business long term. And I do think that it's really the consumer that's going to benefit from these tools because we're going to get them. It's a brand new tool that makes us more efficient for free. So yeah, again, that's a long way for me to say that I don't know enough about the LLM space to pick a winner there. I don't know enough about the chip space to pick a winner there long term. But what I do feel like I know, what I feel very, very confident in, is that we're going to need a lot more infrastructure to power this AI revolution. And Brookfield, in my opinion, again, is the business that has the best experience and the best potential to execute on building out that infrastructure profitably in a way that creates value for shareholders. And that's pretty much the summary of my AI investment and why I think Brookfield or why Brookfield is the stock that I chose. I know it's not sexy. I know it's not, a stock that's going to 10x next year. That's fine. But I do think that it will produce some pretty strong returns that outperform the S&P 500 over the coming decades. And that's really all I'm looking for. I'm not looking for moonshots. I'm just looking for some pretty good investments over the long term. Now, also, one thing that Bruce Flatt said is that specifically for Brookfield, when they're building data centers, what they have on the other side, what they're really doing is they're financing data centers for companies like Google, Microsoft, Meta, and Amazon. But what they're, also countries like Sweden and France, they have massive deals over in Europe. But what he's saying is that they have customers on the other side and immediately. So earlier on in this video, when we were talking about AWS and AWS building out their infrastructure, they have customers paying for their data capacity immediately. So they're getting returns on invested capital, and they're seeing those returns right away as soon as the data center is ready to go. That is exactly what Brookfield is seeing. And that's what Bruce Flatt is saying here, is they have counterparties on the other side with contractual agreements for the capacity that Brookfield is building. Now, the last thing here, what makes Brookfield stand out is they have the experience building power, connecting power to the grid, building real estate, and building data centers. This ultimately means that Brookfield can completely self-fund and self-manage everything from building the power, connecting the power, building the real estate, and building the data center. So I think this will allow them to expand their margins over a business like IREN or NBIS, because those companies do not have as much experience building and supplying power for their own systems. And Brookfield does. They are a massive supplier of power to countries and companies across the planet. So I think that there is a competitive advantage there. So let's continue on with this interview and see what else Bruce Flatt has to say.
Booms in years past, whether it's railroads or fiber optic, they've seen kind of the ups and downs of the cycles too. Are you worried about that? Are you worried that there is too much capital chasing this space because it is so, important right now, obviously, but at a certain price?
So remember, our business is just financing the global best. So we're partnering with Google and we're partnering with Microsoft. We're partnering with countries of the world. And most of those have high A, double A, or triple A credits. And therefore, we're just financing their businesses for long periods of time. And unlike cycles before, which you refer to, when fiber was laid down, there were no counterparties on the other side. So there will be mistakes made by some. But if you know what you're doing on building, if you have the capital right, and if you have counterparties on the other side of your transactions, this is a long, long cycle, and we will all do very well in it.
So you're not too worried about just the overall level of debt that the hyperscalers are taking on to achieve this?
No. This is they're all investing for a very long-term future. And what I can tell you is, from we have 400 companies where we're deploying artificial intelligence, and the early stages of deployment of artificial intelligence is very meaningful to business, and those that get with it are going to excel. And the next 10 to 15 years is going to be very exciting because of that.
As part of your partnerships.
Okay, so in this next clip, there's a few key things here. The first one is Bruce Flatt highlights again that they have counterparties on the other side of all of this build out that they're doing, and they're Google, Microsoft, Amazon, Meta, and literal countries. So as soon as it's built, they have the customers. This is not like the tech bubble when companies were building out the fiber connectivity around the planet, and there was no one on the other side of the build to buy the fiber cables, essentially, or to have the data flow through those fiber cables that these companies were laying across the planet. And that is the main difference from this AI build out versus the tech bubble fiber build out. Is back then, companies were spending so much money to build out these fiber networks, to lay these fiber cables, and then they just kind of hoped that there would be demand on the other side. Whereas today, there is contracted, guaranteed demand on the other side from the largest companies in the world with fantastic balance sheets producing hundreds of billions of dollars in annual cash flow, and also countries that can, they're obviously going to pay their bills. And if they don't, there's a pretty big issue there. So that is the risk difference between this build out versus the fiber build out during the tech bubble. But what's also interesting, Bruce has said this before, is that not all of the capacity commitments that you're seeing today, go back to Oracle, go and watch my videos on Oracle, those commitments that they have from OpenAI. And what Bruce Flatt has said before is that he does not believe that all of these commitments are going to realize or materialize long-term. So there are going to be some companies that just simply get this wrong. They don't have the experience doing this stuff, and their commitments are not actually going to be real when we take a look in hindsight. And I do think that this is the risk with OpenAI, because OpenAI, for example, with Oracle, announced a $300 billion commitment in one single quarter. And, when you take a look at OpenAI producing $15 or $12 billion in revenue this year, you got to ask yourself, how are they possibly going to pay Oracle $300 billion? And that's where I think the risk is with those commitments from OpenAI, or placing your bets on a company that's losing money, and then they're committing to you hundreds of billions of dollars, and then your business is investing in data centers to supply that capacity to them. That is risky, in my opinion. What's not risky is doing that same model with companies that are very profitable, have great balance sheets, can actually afford this stuff, and also working with countries, which is what Brookfield is doing. And what's interesting is I think the market has woken up to the risks with Oracle that I was discussing months ago, which is being reflected in Oracle's share price dropping significantly, and also companies like CoreWeave dropping along with them. We've also seen a little bit of a sell-off across all AI stocks with Oracle as a whole, but I don't necessarily think that this is justified, because I think that we live in this reality where Oracle and CoreWeave and those types of companies can go belly up, well, maybe not belly up, but see significant weakness from all of the debt they're taking on, and maybe their data center buildouts are not going to be nearly as profitable as they think, or they won't realize as the market was expecting them to. That can happen at the same time as other data center buildouts like Brookfield is doing, and the demand that NVIDIA is seeing and demand that Amazon and Google are seeing is actually real and will materialize. So it's interesting to see the entire AI space, if you want to call it that, sell off with Oracle, when I think this is kind of an Oracle-specific issue, an OpenAI issue, a CoreWeave issue, and not necessarily an NVIDIA, AMD, Google, Amazon, Meta issue. I think that those companies are actually solid, seeing a real demand, seeing tangible benefits to their business, and others are not. And I think that when you see this type of indiscriminate selling across the sector, it can actually offer some opportunities to buy the dip, which is what I have been doing with Brookfield. Now, the last interesting point that Bruce Flatt said in this clip is that within a Brookfield's own business, because they're a conglomerate of hundreds of businesses, and within their own businesses, they're seeing artificial intelligence improve the efficiencies. And this is what is giving them confidence to invest so much money into artificial intelligence because they believe that long term, pretty much every single company is going to want to implement artificial intelligence in some form, which is going to require a lot more data centers, a lot more compute capacity, and a lot more electricity over the long term as more businesses realize and learn how to use artificial intelligence to gain those efficiencies. So that's what's giving him the confidence, is just simply the amount of value that AI has already generated for Brookfield. But let's continue on with the last clip that I thought was worth watching.
Sarah mentioned the one with Qatar. You also have Kuwait as part of this AI build out. How are you thinking about regional geopolitical risk, particularly given the evolving tech alliances that we've seen as it pertains to technology and competitiveness?
So, look, all we try to do, because we're investing very large sums of money for very long periods of time. So what we try to do is find good countries and invest with good people in good assets. And if you do that, over the longer term, you're going to be fine. So we just try to, we have 30, 40 countries that we invest into. We go to them, we set up, we stay for long periods of time. And that backdrop allows us to continue to build out what we do in infrastructure. And that's what's more important than, I'd say, short-term volatility in capital markets or short-term political thinking.
This was a great response. And it's actually how I think about investing as well, because especially with how polarizing politics, I'm not going to get into politics, by the way, but with how polarizing politics has gotten over the past few years, really since COVID, I've seen, even in my own communities and even in the comment section, people asking me, well, how could you possibly be wanting to invest in Canada if X person is in charge? Or how could you want to invest in the United States with X person in charge? And don't you think that this will impact the fundamentals of businesses or the investment climate of this country as a whole long term? And I agree with Bruce Flatt here. I think that politics change. I think that politics is kind of just like volatility. And over the long term, it really doesn't matter that much. I mean, if you take a look at the S&P 500, it's continued to rally and go up and continue its trend for pretty much ever, regardless of whoever is in charge, regardless of which political party is in charge. So I really, really try not to let my political biases or beliefs affect my long-term investment decision-making. And what I try to do is actually get down to the micro level. Bruce is maybe needs to focus more on the macro level in terms of, which countries Brookfield is deploying capital in. But for me, as long as the country as a whole, I think, is stable and it's not experiencing hyperinflation, it's democratic, and I think just a solid country long-term, then really what it comes down to for me is the business solid? And is the business a good one that I think will continue to grow its profits over the long term? So I do, try and find the markets like Japan and Sweden and Australia and Canada and the United States. Those are the markets that I'm currently invested in. And I believe that those economies will continue to allow businesses to succeed over the long term. So then really what it comes down to again is, okay, well, now let's find some good businesses that I think deploy capital wisely and will continue to grow their fundamentals over the long term. So I don't necessarily try and focus on, okay, well, this political party is in power or this mayor is in power, so that makes this whole region uninvestable. I just don't agree. I think that it's all short-term noise, and long-term, all that matters is the fundamentals of businesses continuing to grow. So I do agree with Bruce Flatt on that point, and that's kind of my views on politics when it comes to investing, and I really try not to let it influence the way that I invest or make investment decisions. But with all that being said, that is going to wrap up the video for today. I hope that you enjoyed this video. Hopefully it's a little bit of a shorter one. And if you did enjoy this video, then please remember to leave a like on it. And as always, I truly do appreciate you taking the time to watch my videos and support my channel. So with that being said, thank you again, and I hope to see you in my next video.